Rebooting QE, the Federal Reserve's new strategy using banks. Quantitative easing, QE, is expected to make a comeback, but this time it may not be visible on the Federal Reserve's balance sheet. Instead, there is a possibility of a stealth QE carried out by banks themselves. This can be achieved through a simple rule change in the bank's leverage rules. The impact of this change would be to bail out both the financial system from a liquidity crisis and the U.S. government from a funding crisis. In the next few minutes, we will explore the history of U.S. debt, the role of the Federal Reserve, and the potential for stealth QE through banks. The history of U.S. debt. The U.S. government's total debt has been steadily increasing over the years and currently stands at $34.5 trillion. However, if we look back at the first 60 years of U.S. history, we can see that there were periods of debt growth and debt repayment. This was because the money supply was limited by the gold reserves in the banking system. Unlimited debt would have led to defaults and bank runs, causing deflation. But with the creation of the Federal Reserve in 1913, the only constraint on debt expansion became political will. The government made a commitment to never let the debt or money supply contract again, leading to a continuous increase in the national debt. The role of fiat monetary system. In a fiat monetary system, money is lent into existence, but debt requires interest. Eventually, the debt must be repaid with interest or defaulted on, leading to a contraction in the economy. However, in a fiat system, the government can choose inflation instead of deflation. By printing money, the government can keep the debt pile growing and avoid the pain of contraction. This has been the path chosen by policymakers, as they print money whenever the cash in the system runs out and the debt is close to defaulting. The last time this happened was in 2019, when the U.S. government had borrowed all available cash, leading to a liquidity crisis. The liquidity crisis of 2019. In September 2019, the U.S. government had borrowed all available cash from the financial system, causing a liquidity crisis. Banks didn't have enough cash to lend to each other, leading to the near collapse of the repo market. Banks faced the risk of collapse as they couldn't locate the cash they needed to pay their bills. To avoid this crisis, the Federal Reserve intervened by starting quantitative easing again, buying assets and injecting cash liquidity into the system. The potential for stealth QE through banks. Currently, the Federal Reserve is facing a problem with inflation. They cannot be seen as abandoning the fight against inflation, as stable prices are one of their mandates. However, they may be able to accomplish a stealth QE through banks without increasing the size of their balance sheet. The key lies in changing the leverage rules for banks. Currently, banks are limited in the amount of treasuries they can buy. But if the leverage rules are changed, banks can become limitless purchasers of U.S. treasuries, effectively loaning money into existence for the government. This would enable the government to borrow without facing liquidity issues, while banks keep the interest and bear minimal risk. Conclusion. The potential for stealth QE through banks exists, where banks become the source of unlimited borrowing for the U.S. government. By changing the leverage rules, banks can buy an unlimited number of U.S. treasuries, effectively printing money into existence. This would bail out the financial system from a liquidity crisis and the U.S. government from a funding crisis. The Federal Reserve can maintain its credibility by not increasing its balance sheet, while enabling the very thing that fuels inflation. Understanding this potential can help investors position their long-term investments accordingly.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.